I lost 40% of my portfolio due to my own mistakes. So, today I'll show you how I recovered using SCHD and exactly how much you need to live off SCHD dividends, using my personal 10-step strategy to avoid the same errors I made. Dividend investing was a game changer for me. I used to chase growth stocks, hoping for that big win. But here's the thing. Growth stocks are volatile. You can get huge gains one day and see it all disappear the next. I learned that the hard way after a tech stock I invested in crashed, wiping out a significant portion of my portfolio. That's when I knew I needed a different strategy, something more reliable. SCHD stood out to me because it's packed with solid blue-chip companies that pay consistent dividends. It gives you income stability and your investments still grow over time. That was exactly what I needed to stop the sleepless nights worrying about market crashes. But the real question is, how much do you need to invest in SCHD to live off its dividends? Let's break it down in 10 simple, actionable steps. Step 1. Understand dividend yield. This is simply the percentage of your investment that gets paid out in dividends each year. SCHD typically offers a yield between 3.5% and 4%. So, for every $1,000 you invest, you'd get around $35 to $40 annually in dividends. Now, here's a mistake I made early on. I assumed the yield would always stay the same. Big mistake. Yields fluctuate based on market conditions, and I didn't factor that in. For simplicity, we'll assume a 4% yield today, but always keep an eye on it. Step 2. Determine your annual expenses. The next step is figuring out your living expenses. You might already know this, but I underestimated mine. When I first calculated, I forgot to include some things, like vacations, emergency medical expenses, even higher energy bills during winter. So don't just think about your current lifestyle, think long-term. What will you really need to live comfortably? For me, $40,000 a year is what I aimed for, enough to cover mortgage, groceries, insurance, and a little extra for fun. Step 3. Calculate your required investment. To figure out how much you need invested, use this simple formula. Required investment equals desired annual income divided by dividend yield. If you need $40,000 per year and SCHD's yield is 4%, you'll need $40,000 divided by 0.04 equals $1 million. Yes, $1 million. And here's the controversial part. It's less than what most experts will tell you. They'll scare you into thinking you need $2 million or even $3 million to retire comfortably. But if you're disciplined with your investments and focus on dividends, you can live comfortably with $1 million invested. Now, I know that $1 million might sound impossible. Trust me, I've been there. I remember looking at that number and thinking, how am I ever going to get there? But don't worry, it's more achievable than you think. Step 4. Scenarios for different lifestyles. Not everyone needs $40,000 a year. Maybe you live in a lower cost area or have fewer expenses. Let's break it down for different income levels. If you need $30,000 a year, you'd need $750,000 invested. Want a more comfortable lifestyle with $50,000 a year? You'd need $1.25 million invested. The beauty of this formula is its flexibility. Your target number is based on your lifestyle. You don't have to follow what others say, customize your goal to your life. Don't make the mistake I made of comparing myself to others. I thought I needed way more than I actually did, and it only stressed me out. Step 5. Reinvesting dividends for faster growth. Here's one of the best secrets to building wealth faster. Reinvest your dividends. When I first started, I didn't do this. Huge mistake. I was too focused on taking the cash to fund a side project that never went anywhere. Had I reinvested those dividends, I could have hit my financial goals much sooner. Let's say you invest $50,000 in SCHD, and with a 4% yield, you earn $2,000 a year in dividends. Instead of taking that $2,000 and spending it, reinvest it back into SCHD. You're now buying more shares, which means you'll get more dividends next year. This snowball effect can supercharge your portfolio growth. Trust me, it makes a massive difference. Step 6. Dividend growth as a hedge against inflation. Here's another thing I didn't fully appreciate at first. dividend growth. Many of the companies in SCHD tend to increase their dividend payouts over time. So, even if inflation eats into your purchasing power, those rising dividend payments help offset it. My portfolio is now producing more income than when I started because of this dividend growth. This is crucial for long-term investors. It's a built-in hedge against inflation, and it's one of the reasons I stick with dividend ETFs like SCHD. Step 7. Maximize tax efficiency. Let's talk taxes, another area where I made a blunder early on. In the US, dividends are typically taxed at a lower rate than regular income, but only if they're qualified dividends. SCHD pays qualified dividends, so they're taxed at a more favorable rate. But here's where I messed up. I didn't structure my portfolio with tax efficiency in mind. I had investments scattered in different types of accounts, which made my tax situation more complicated. Lesson learned. If you want to keep more of your money, make sure your dividends are being taxed at the lowest rate possible. Talking to a tax professional about your dividend strategy can save you headaches down the line. Step 8. Diversify for stability. Here's something you won't hear from everyone. SCHD is great, but you shouldn't put all your eggs in one basket. I made the mistake of going all in on dividend stocks at one point, thinking they were invincible. But I learned the hard way that even solid companies can cut or suspend dividends during tough times. So I started diversifying into other asset classes like real estate, bonds, and even other dividend-focused ETFs. You don't want your entire financial future tied to one type of investment, no matter how good it seems. Diversification is your safety net. Step 9. Create an emergency fund. Before you go all in on living off your dividends, make sure you have an emergency fund. I didn't, and when an unexpected medical bill hit, I had to sell some of my investments. Not only did I lose out on future dividends from those shares, but I also had to sell during a market dip. Double loss. Aim for 3 to 6 months of living expenses in a liquid account. This fund will be your buffer when life throws curveballs, and trust me, it will. Step 10. The path to $1 million in SCHD. Let's say you start with $50,000 and contribute $10,000 each year while reinvesting your dividends. Assuming an 8% average annual growth rate, including dividends and price appreciation, you could hit $1 million in about 26 years. Sounds like a long time? Sure. But you can speed things up by increasing your contributions or boosting your income through side hustles. Consistency is key here. It's not about timing the market, it's about timing the market. Dividend investing changed my life. I went from worrying about every market dip to having a plan that generates reliable passive income. SCHD has been a cornerstone of that strategy, and if you follow the steps I laid out today, avoiding the mistakes I made along the way, you can do it too. Now that you've seen how SCHD can help you achieve your financial goals, there's one more strategy that can maximize your returns even further. Check out my next video where I teach you this advanced investing approach to supercharge your growth.